Thanks, Tim. Welcome, everybody. Great to be here. Lots to talk about, so we'll get straight into it. But you've already done a little bit of work in doing that first live poll. This session has 4 live polling questions. You're not allowed to do the 4th one yet, but I would encourage you to pick it out and get ready to start looking at that first question. But in fact, why don't we do it now? So we're going to talk about asset allocation. We're going to talk about strategy. Let's get it going. We ask this question every year. So if you can please take it out. As you're sitting here now at the beginning of this session, what do you think represents the best opportunity for clients currently? You got 6 options there, from cash, fixed interest, REITs and infrastructure, Aussie equities, global equities, and alternatives. While you're filling that out, what I will show you is, and don't copy, this is from last year, the 2016 results that were put together at the start of the session. Oh no, sorry, at the end of the session. What was interesting is last year, the difference between the start and the end was a move from Australian equities into alternatives. But as you can see there, the big preference came through on global equities, followed by alternatives, followed by Australian equities. That has been there for the last few years. Just quickly before we go to the results, what's happened over the last year, and clearly you're all long-term investors, so this isn't meant to be a guide or anything, but it is interesting to see what has happened in markets. So we saw a pretty strong market over that 12 months to 30 April, both Australian and international equities performing quite well. Infrastructure, listed infrastructure also returned fairly strong returns. REITs, both global and Aussie REITs returned around that 5% mark. Then you had alternatives, and we know alternatives, depending on what you hold, make a big difference, but they were there. So it was a strong market. So generally, the opportunities you saw in equity markets certainly played out. But can we see how we're thinking currently, please? If we get those live polling results up. So probably a shift back to global equities. The ranking is probably still similar, except alternatives, and I'm assuming most people are probably saying that represents other, but alternatives are there as a big thing, and still people looking for global equities. A few of you are still keen on cash, that's great, and we'll talk a little bit more about that. So not a lot of change. We'll ask the question again at the end of the session. But this session is about asset allocation, it's about strategy, it's about this world of putting order in this world of disorder, so to speak. And it's great that we have two panellists with me today. You can read their bios in the actual booklets on your table, but Daniel McDonough is Head of Portfolio Management, Europe and UK from Pierford and joins us from London. And Andrew Lill, Chief Investment Officer, APAC for Morningstar Investment Management. What I can tell you that's not in there, both of them hold UK and Australian passports, and only one of them would be disappointed if Australia won the Ashes, but I won't tell you which one. You might struggle to guess though. Gentlemen, we just had a great session talking about geopolitical risks. The reality is we've had geopolitical risks for decades, but about a year ago, Daniel, while you were sitting in London, there was a vote. It was called Brexit. And in a way, that sort of started off the latest round of chatter around popularism and what's happening in society and that connection between politics and markets. Give us your update. What was your take on Brexit and where do you think it stands now?
Sure. I guess in many ways, the UK was a pioneer in this slide towards global populism that we've seen over recent times. I guess the real danger with the way that manifests itself in the UK is that this is potentially a permanent change. We're told that Brexit is for life. It's not just for an electoral cycle. So potential repercussions on that front there. And the risks depend really on which side of the table you're sitting, I think. So for Europe, there are also risks, but they are mainly political in nature. The worst outcome from a European point of view is that the UK moves outside of the EU, makes a success of it, and provides a great advertisement for what can be achieved, which of course would give voices to the other sort of countries that might be contemplating a similar path. So they don't want that to happen. Conversely, for the UK, the key risks are, I think, economic, and they really revolve primarily around the threat to trade. Access to that EU market matters because it is the biggest market for the UK. It's responsible for taking close to half of the UK's exports. And we have this 2-year window whereby the UK is going to try and strike a trade deal with the EU, and the clock is ticking on that. And not much progress has been made so far because we decided to have another election ourselves, which takes us through to June. Then, of course, we've got the German elections in September. So technically, we're negotiating with Brussels, but Germany have a key voice within that, and we're not quite sure who the leader will be there yet. Yet. We have a good idea, but they will be otherwise occupied for the next few months. And the other issue is that the EU have said, look, before we even begin to talk about trade, we need to talk about the bill for leaving, which, by the way, is tens of billions of pounds. So it's not going to be something that's signed off very quickly. So, we're going to have significantly less than 2 years to try and negotiate a trade deal. By comparison, it took Canada over 6 years to get their recent trade deal with the EU. So it's quite a big ask. I'd say there were real economic risks for the UK there. Now, they're not the only risks. Of course, it's opened up a can of worms in the sense that Scottish independence is back on the table. Scotland was very pro-EU and now want another referendum on independence. There are potential repercussions for Ireland as well, where there is a barrier between, or a frontier between the EU and non-EU. So a lot of things up in the air. It's no wonder that our Foreign Secretary referred to Brexit as probably going to be a Titanic success, with an emphasis on the word Titanic.
But so you're managing a portfolio through this, and you said 2 years is going to be pretty tough. So I'll convert that to saying it's probably not going to happen. It's going to be tough to get that done in 2 years. But
agreed.
Yeah, so you're still going to have this political overcast, but you're running a portfolio. But so how much of Brexit, how much of that is actually flowing through in the way you think about the portfolio, or is it still just happening? And this comes down to that core question: you've got this political sphere happening out here, then you've got company earnings and company balance sheets.
Sure, and of course, a lot of the companies within the UK don't rely on the UK economy particularly for their earnings streams. There's a lot of multinationals there. But we are sufficiently worried about the prospects for Brexit that we have gravitated towards those multinationals. And where we do have domestic exposure, it's in the more defensive end, the utilities that are likely to be able to trade through that environment without too much problems. The equity market hasn't really taken the hit yet in the UK from Brexit-related issues. We're sitting at record highs almost on a daily basis. It's been sterling that's taken the issue. Yeah, it's weak on a fair value basis, but there's good reason for that event risk clearly in the next 2 years coming up.
Okay, Andrew, finding order in the new disorder. Your take on geopolitics, it's not only about Europe clearly, but how do you think about, or what are some of the observations you're seeing when you look at the world?
Yeah, well, thank you, Anthony. I was really excited to actually kind of start thinking about this topic because I think it goes to the heart of long-term successful investing and how we approach it as long-term valuation-driven asset allocators around the world. So the first thing is, disorder. Like, is it any different this year to past years? I mean, I would say that at the start of every year, kind of if you sit down put your major risks on a bit of paper, then you probably have a list about as long as was the case at the start of this year around political risk, about changes in trade. I guess what's changing is because we are wired to want sort of short-term information, and the media give us that short-term information via our apps and our Bloombergs, then the information available on geopolitics and what may be happening in the Trump Oval Office or in Japan or North Korea right now is just so much more available to us. How do we deal with that? And I'm going to answer the question directly and then come with some sort of suggestions to you as a group of advisors sort of working with your clients. So first of all, how do we deal with that? Well, the important thing from finding order for us is seeing kind of the true north in our navigating through a sort of a difficult environment as being fundamental valuation. Over time, long-term markets tend to react to fundamental valuation, and we seek to try and find assets or companies where the price is below the intrinsic value of that company or asset class, with a sufficient margin of safety to compensate for the risks. So right now there are some risks around globally, and we think about which companies or countries' equity markets are priced with an appropriate margin of safety to compensate for the risks. Libby did a great job in this first session about talking about what may or may not happen in the Trump Oval Office. I think the fact that PIMCO are putting so much attention on this, yet there's still a lot of uncertainty there, shows that it's probably not worth spending too much time looking sort of for certainty and just looking at the probabilities. If you look at the markets, I can say to you that the US equity market has priced in more of a right tail outcome, more positive outcome. And so potentially there is not the margin of safety there in the prices if a left tail outcome were to eventuate. Whereas I think South Korea and Japan, as the kind of the countries closest to North Korea, for instance, are probably pricing in now more of a left tail outcome. There's more of a margin of safety compared to long-term intrinsic value. And so potentially, in an uncertain world, it may be better to actually think about investing in countries like Japan or South Korea rather than the US based on valuation. That's the sort of the direct answer. The indirect answer, and really kind of how I would encourage us to go forward with this, rather than continuing sort of to read the kind of the overnight stories, is I got a lot of value recently out of reading the book Michael Lewis, The Undoing Project. Everyone kind of heard of that? Effectively, he wrote a book that was an easier way to read Daniel Kahneman's Thinking Fast, Thinking Slow. If you're a nerd like me, you read Daniel Kahneman's book. If you're perhaps not quite so much the nerd, then it's worth reading Michael Lewis's book, The Undoing Project. And it's basically about two psychologists and how they've applied that to how we program our brains and how we think. And the link there is to behavioral investing. There is definitely an availability bias or an availability heuristic in the way we make decisions. And bringing that back to today, I'd say right now we attach greater certainty to things that we think we're observing more recently. Because we read stuff in the media, we attach greater certainty towards that. So right now we might have excessive fear attached to geopolitical risk and potentially unjustified confidence to things that we're not actually focusing on. And of course, the media tend to not focus on things that are not read immediately overnight. Just this morning I read, it was very hard to get there amongst all the kind of the Trump discussion, but actually that Japan has just had its fifth quarter under RBA and Abenomics of GDP growth. It's the first time since pretty much the late 80s. You have to work very hard to get that information outside of kind of the major tweets. And lastly, if you want to kind of to follow kind of a popular person with tweets, I would say, Bill Gates is somebody who tends to do a lot of good in the world, but tends to put a lot of tweets out. Yesterday, he tweeted as a sort of advice to college graduates that right now we're actually in a world where there is less conflict, and human safety is getting better and better every year. So he's very positive about the future, and we as active managers are very positive about the future too.
Okay, so both of them pointed to this idea of looking through the headlines through to the fundamentals. So maybe can we think about equity portfolios at the moment for a bit, Daniel? Where are you seeing the opportunities, or how are you positioning your equity portfolios?
So we probably get most excited about Asia ex-Japan. We like the valuations there. We also like some of the longer term structural drivers, the demographics, the fact that debt perhaps hasn't been used as aggressively as in lots of the Western economies. They had their crisis back in '97 and seem to have learned something from that. And that ability to create credit to an extent is just such a big driver for global growth. You look at that, or for national growth, you look at that, the flip side, and the very indebted Western economies, and it's just a millstone around the neck. It's a ball and chain. It's really hard to grow robustly in the absence of credits. So we essentially have the brightest outlook for that part of the region.
Great. So, okay, what about you, Andrew?
Yeah, similar. I think really the important thing that when we apply long-term valuation methodology to the equity markets, there's nowhere that's really cheap. It's really about sort of on a relative basis. The likes of the US and potentially Australia look a bit more expensive, And Europe, Japan, and the emerging markets, particularly Asia, look a little bit more attractive. I think the key thing for us is within that, how do you find opportunities? Because worth staying invested in the US, but what do you invest in? And we probably look for quality companies in the US. We have a focus on potentially kind of older technology like Microsoft that can deliver a lot of free cash flow and is not priced so perfectly for growth. And some of the healthcare companies that are actually going to do very well out of future kind of oncology drugs that will get people away from chemotherapy. Into Europe and Japan, it's about finding the sectors that are priced most attractively with the biggest margin of safety. And straight away, we'd probably go to European energy or European financials as a great opportunity. In general, it's best to invest in companies or sectors after they've been resized for the future. And it's clear that both through energy companies sort of resizing through lower capital expenditure for a lower oil price, or for European financials resizing, reducing leverage for a lower growth future, then actually they're looking very attractive on a long-term basis.
So European financials, I think you've got a different view, didn't you?
Yeah, we've steered clear of those for several years now. Not to say that the outlook hasn't brightened considerably, so capital positions are probably stronger than they have been in recent years. They might not be exactly at the levels that regulators are comfortable with, but they're a lot closer than they were. The threat of a liquidity crisis has probably been short-circuited because central banks have those platforms in place to provide liquidity if it's needed. And we thought maybe rates were raising there at the end of last year. And of course, that has positive repercussions for interest margins. So I can understand the attraction on that level. I guess what outweighs that in our view is a pretty pessimistic macroeconomic growth forecast on our part. And if you take the point that we have probably more debt in the system now than we did on the eve of the financial crisis, certainly in Europe, and that's true at households as well as public, the prospects for top-line growth, just credit growth in the banking system isn't particularly great. Certainly in Northern Europe, non-performing loans have been very well behaved lately. Wouldn't take much there to eat into profitability. And we also worry in the European context about what I'd call legacy issues. Greece is bankrupt still. It gets kept on life support with liquidity provision, but at one stage or another, they're going to have to deal with that. It was only in Q4 that we saw the extent of the non-performing loans or the bad debts in Italy. Now, they did clean some of that up in the biggest culprit, Montepaschi di Siena, but on some estimates, non-performing loans are approaching 20% of GDP in Italy, so that's not a one-bank issue. That's systemic in that country. And again, in Q4, it was only then that we were asking questions about whether Deutsche Bank was a going concern. So, when these things flare up, they get played out most violently in the financial sector. When you have that emphasis on preservation on capital, as we do, it's difficult to jump in with both feet.
So I'll come back to you, Andrew, but I just want to tie that back. We had one of the questions, so thank you. Please send your questions through. But rightly, as you alluded to, a few years ago, it was all about pigs, led by Greece, right, constantly on the cusp of defaulting, constantly in the headlines. It seems unavoidable. Why aren't we hearing more about it? You just talked about it, but why aren't we hearing more about it?
They've got it under management in the sense that if you provide the liquidity, then Greece can survive. It's that old kicking the can down the road. And there used to be a lot more contention around the periods when liquidity was given. So the conversation would go something like Greece would say, "Can we have the money, please? We need it." The EU would say, "Well, give me some more structural reform." Greece would say no. EU would say, "Well, you're not getting the money." And Greece would say, okay, we'll do it. And that took a couple of months to play out, and markets got very nervous around that because there was the potential for Greece to say no, to get kicked out of the program and to have to default, and therefore essentially leave the euro and that, all the questions that come with that construct. Greece has been a bit more pliant lately. The real risk there has tended to be around the IMF. They are part of the institutional framework that provide liquidity, but they're not allowed to provide that liquidity if they don't believe that the loans are sustainable in the long term. They're making that point, but They're managing to fudge it so far, but it's just there in the background. It's an issue, a cloud that hangs over Europe, I would say.
Okay, so just quickly, Andrew, I mean, you probably see all of this stuff as well, but you're comfortable from a pricing when you're thinking about European financials?
Yeah, I mean, absolutely. The risks are absolutely there. We live in a world that has lower growth, higher household debt, higher government debt, and whether it be China, whether it be the Southern European countries, whether it be Australian households, we're all challenged. I think it's just really for us about when you're in that world of there are risks around, but you need to achieve your return targets through the cycle to achieve your customers' growth objectives. Then you have to take risk. You take risk cautiously, and the biggest test for us is that price. Does the price basically bear the risk? Are the risks in the price, or are the risks actually not in the price? And for us, in most of the European sectors, then actually the potential sort of for growth from here encompasses the actual risks involved.
Thanks. Let's talk Australian equities. Looking at your portfolios, you both have different weights. I might actually start with you, Daniel. When you look at the Australian equity market against other markets, or maybe the way you think about Australian equities inside the portfolio, please?
We like the Australian market in the sense that from a valuation perspective, you get a dividend yield that starts with a 4, which is double the level you would get in Japan or the US. Dividends we like as a house generally. We know that it provides the bulk of total return throughout history. Of course, to talk about dividends as attractive, they have to be sustainable. So you have to be confident that the companies that you own within Australia are able and willing to continue to pay that, which is clearly cash flow analysis that comes down to. But we think you can find opportunities there. We also like the way that the government here has really an enviable fiscal position compared to lots of the Western world. If things do come off the boil, they have some wiggle room to be able to support the economy if they wanted to, and politicians tend to want to do that. We also like the Australian equity market in the product that we run, partly because of the liabilities being in Aussie dollars as well. So that's a factor, but even on a standalone basis, the Australian market is something that we quite like.
Yeah, so we might get on to currency in a moment, but Andrew, your views on Australia and the position around Australian equities?
Yeah, I don't think they're that different. I guess the only thing I would say is that we know that the Australian equity market is very concentrated, that the proportion of the index, the ASX 200, taken by the two big sectors is very large. And so when you're thinking about Australian equities, if you can take a sort of a benchmark unaware approach and finding those pockets of value and strong growth, and generally that means probably avoiding the higher dividend yield kind of companies where we feel that they have been driven by this sort of insatiable search for yield amongst retirees towards valuations that are very expensive. I think that we feel confident that we continue to take and find good opportunities in Australia, but probably just not in a kind of an index kind of way. And so there are some good companies in that top 50 area that are both liquid and offer growth potential, but perhaps the top 10 looking from our point of view less attractive. Mm-hmm. There's also the point that in really sort of designing multi-asset portfolios for your clients, most of your clients will probably have quite a high exposure already to Australia, either in their income or also in their approach to investing outside of super. And so we do think that Australian equities have to hit a higher hurdle to actually be a material part of our portfolio.
Okay. Great. I'm going to ask you all, if you haven't already, can you have a look at the live polling question on what is your view on the Australian dollar? Can we get that question up on screen, please? Asked this last year. Undervalued, fair value, overvalued. You won't be surprised to hear that last year, I think 62% of people said that it was overvalued. The reality is that probably it's traded in a fairly narrow band over the last 12 months. But if we could get the results coming through now, just a bit more, if we could just show those on screen quickly. Yep, they're up. So it's a bit more, certainly much more of an equal weighting there between fair valued and overvalued. What's your take on currency? How does currency work in the portfolio?
So
Daniel.
for us, we do actively manage currency. We always look at it through the prism of purchasing power parity analysis. And on that basis, we would agree with the poll there that it is still a little bit expensive. Nothing like the sort of levels of 2012, of course, but still something that has scope to further go down. And when you expect that, then if you have an expensive base currency, then we're happy to essentially put assets anywhere other than that. So that's part of the process for us.
View
on Australian dollar, Andrew, or currency?
Yeah, so long term, we think that the US dollar, Australian dollar kind of sort of equilibrium rate perhaps exists in the top 60s. It's been fairly stable in the last sort of 2 years, around that sort of 70 to 78. The two things that really drive the Australian dollar versus the US dollar are the interest rate differential. It looks on the balance of risks that might close going forward. If the Fed continues on a raising rates schedule, then there's the balance of trade, or sort of effectively the trade, which is for us driven by China, or whether that's above average or below average. If you're going to sort of predict from here that interest rate differential is going to narrow, and potentially there's an opportunity or a challenge for balance of trade with China sort of to reduce going forward, we think there's a potential of mid-60s or potentially even lower, because the Australian dollar does tend to overshoot. If you think that balance of trade will stay above average, we think that the 70s sort of makes about sense. The one area that we do sort of actively manage currency in the portfolio, we continue to think that when you have a bias towards potentially Asia and emerging markets in your portfolio from equities, then actually holding the Japanese yen makes sense because it tends to be pro-cyclical. Japan and emerging market equities will do well when generally growth is pretty strong. The Japanese yen is quite a good hedge for that it tends to be a flight to safety when you get those concerns and those risks in the economy.
Okay. I'm going to start flying through some of the questions, so we don't, tight on time, so a bit like a speed dating session. But there's a good question here on bonds. So in a lower growth, higher risk world, do bonds actually perform better than the consensus expectations? What are you thinking about bonds in the portfolio?
Yeah, from our point of view, we think they're expensive. We don't think there's much value in sovereigns at all. On a historical view, you'd be looking for between 1.5% to 2% real on a mid-range bond, but that's not something that we expect to get given current yields. So we think they're expensive overall. When it comes to bonds, we see currency as being perhaps a more promising angle for trying to generate return than the actual bonds themselves, which is unusual.
Yeah, so if we get another, but you say there's certainly some risks out there in equity markets. So bonds, I think, would you say, can they be as much of a defensive play as they were during the last big equity market downturn?
They can be. I think they can be defensive in the sense that you cannot lose money if markets turn south. So if you're placed at the short end of the curve, you have short duration, then they can essentially be a proxy for cash, which is clearly defensive. But the last global financial crisis, there was actually excellent opportunity to make money at the long end. That's not something we see now, so it's very different.
Okay. There's a question here about credit, and it's specifically the explosion of credit growth in China. Credit generally, China specifically, any concerns around that in terms of risks?
Yes.
Yeah.
Certainly the credit provides a greater spread, greater yield over sovereigns for a reason, that it is intrinsically riskier. We just feel that with spreads in credit having come in so much, you're just not getting paid for those risks, and potentially certainly not getting paid in China credit for the risks that are inherent in kind of the very leveraged balance sheets.
Same, Daniel? Yeah.
Yeah, China, when we talk about concerns about debt on a global basis, China increasingly is part of that. You look at the response that the authorities had to the financial crisis and the explosion of credit that China experienced after that. You can't push that much money in the system and not have some white elephants. There are projects there that did not make sense. And again, starting to recognize those and take losses on those is a process that hasn't really begun. Of course, credit growth has slowed since that period, but it's still in the double-digit levels on a much inflated base. So when we talk about a debt problem, we think China is part of that now increasingly too.
Okay. Interesting question here, or take on it, is sort of saying that it's about synchronized growth, and the view is the takeaway was you seem pretty rosy on your outlooks. What are the risks to desynchronizing growth? And actually, are you rosy?
I wouldn't describe myself as particularly rosy.
No? No
in
flowers?
terms of no, pretty barren in that sense.
Okay.
So growth for us, we're concerned about. It comes back to what we see as the biggest problem in the global economy, which is the level of debt. To have this much debt in the system at this stage in the cycle is potentially toxic. You want to have that debt card to play when things reverse, and I just don't think that that's the case this time around. So we expect a slower growth environment, and therefore we're really trying to concentrate on instruments that will be able to trade through that with little concern, rather than going to the stars, so to speak, in a high growth environment.
Okay, great. Andrew?
Yeah, I mean, we are definitely cautious and definitely aware of the risks. I just think this current sort of difference between low volatility, although overnight that changes very quickly, and equity valuations and bond valuations. We just are very expectant of that volatility increasing and being able to yield opportunities that we can invest some of our cash holdings into. So cautious, but with basically looking out very carefully for the next good opportunity to generate returns.
Great. I'm going to ask everybody to now go back to that question. The fourth question, you'll see there's two more live polling questions. I probably won't. It'd be great if you could answer the one about multi-asset investing in terms of you as advisors, whether or not you're using multi-asset solutions more or less. But I particularly want you to answer the fourth live polling question, and we'll probably get that one back up again and see if there's been any changes or thoughts in that. If you could complete that question on the screen as we go out. Remembering when we started, there was certainly 45% were with global equities and 28% with alternatives, 15% for Aussie. So global equities continues to sort of play out there. So it'll be interesting to see. Certainly the global equity market has a lot more opportunity. Closing thoughts, and then we'll close the session, gentlemen.
Yeah, as I said, caution is the watchword certainly at our house. Just because bonds are expensive doesn't make equities cheap. We believe that sometimes in order to achieve those longer term return goals, capital preservation is good to concentrate on, and that's probably where we sit at the moment.
Okay, great.
We think that given the level of concentration in the Australian equity market and the amount that most superannuants and investors have invested in the top 10 Australian equity companies, it's wise to just think about different contributions to risk in your portfolio. And for us, many of those exist in global equity markets, global currencies, and being sort of able to invest at good valuation times.
That's great. Ladies and gentlemen, please thank Andrew and Daniel.